Good morning, everybody. It's Christopher from Serene Education with the 4 major notes update for the 22nd of January. I'm going to do something totally different today, guys. Spent the day yesterday with a number of our students on a refresher down in Cardiff in Wales, and the talking points, or what came across during the course, was the fact how to go about setting up your long-term support and resistance lines, pretty much putting together your analysis. I'll give you a quick synopsis of how I do it. I do most of my analysis during the weekend, primarily a Saturday or Sunday, more likely a Saturday morning. Grab a nice big cup of coffee, head off to the office upstairs and knock the door and spend a good couple of hours just regurgitating what happened the week before and replotting any major support and resistance levels. So what I'm going to do over the 4 majors this morning is just to go over in a bit of detail how I go about plotting my long-term support and resistance levels so that I can get a better idea of what is likely to occur during the course of the new week. So without further ado, I'm going to start with the euro against US dollar on a monthly chart. Okay, I step back, look at the bigger picture. It's always very, very important to see the big pictures, primarily because all your institutional traders, the big boys, will be looking at these larger time frames to see exactly what price has been doing over a number of months. So without further ado, let me crack on here. Let's have a look at euro against US dollar on the monthly. And what can you see straight away? Straight away you can see that we had all-time highs here back in what was that? That was 2008. I've taken the wrong 2008. You can quickly see price reach its all-time high, and then we subsequently saw the fall for the euro against US dollar. And over the years since then, we've had price pulling back quite aggressively, however not being able to break the prior high that preceded. So in doing so, you can very, very clearly see that we have a downtrend in place. And notice where price is right now in terms of the hard right edge. You'll notice where the trend line is in play, and it's very, very important. You could either do that. That primarily is just a fake out. You want to go for the major highs. You can see there we had one over here, through here, there again, and price is broken through it. Now you can either be very aggressive and do it that way. There's no hard and taut. I mean, the more touches, the better. You'll notice that the all-important indicator over here quite clearly is, if you look back, you'll notice that we had a price support and resistance level there, in fact. So price has tested it over the past month or so, through December, in fact. However, January has taken a lot of that buying sentiment that we saw the month prior back already, and we still got a week to go before the end of this month. However, that's one way of doing it. The other way to do it is to get rid of all these lines. If you know, well, you can keep the trend line if you wanted to. However, I know that we're seeing swing lows, primarily because the highs aren't getting any higher over the month. What I want to do is I use my fib levels, and I take the fib from the, if I look at where price is trading right now, you'll notice that this is just a pullback from a prior major swing low, this extension here. So what I'll do is I'll take the high of that to the current low, okay, and that will be my fib retracement, because now price is pulling back. It's bounced quite comfortably. Where is it likely to target on the pullback? I mean, it can go all the way back to 0 again, or the 100%, which is ideally what we like to see. But along the way, it's going to target certain area points as potential targets. It's the same case. If you get into anything, you want to see a valid target, or you will have a target in place before you actually place a trade. And there's no difference here when you're looking at your fib. So I change all my monthly fib lines are done in blue, for example, so I know exactly what they are when you're looking at your shorter term time frames. So my blue ones go in. Okay, fantastic. Now you'll notice on the hard right edge, you'll see what price has been doing over the past couple of months. In fact, through December, November and October, you'll notice that price has been trading between both the 50% fib retracement and the 61.8 fib. Okay, so we have a lot of consolidation occurring on our monthly time frame. So if we drop down to our weekly now, you can see that happening quite clearly. A lot of movements backwards and forwards between these 2 points. So you could see quite clearly, if we had a failure at 61.8, then aggressively you could have actually traded counter trend towards a 50% retracement level. It's likely to occur like that over and over again. You can quite clearly see it. We went through a bit of a consolidation pattern through most of February, April of last year. Price broke through it. It fell towards the next level. Failed to actually break the next level. It will then bounce up to the prior level it came from. Failed to get above that level, it will fall back the level it's just fallen from. And that's how I use my fib levels. If she fails to rally and break current highs, she's more likely to consolidate with an outlook for further falling back to the prior level she's just come from. It's that simple, guys. Okay, fibs are fantastic. You'll notice there's a lot of consolidation around these monthly and weekly fib levels, and that's the reason why I use them, because all the bigger boys are using them. Now, if the bigger boys are using them, then price is likely to mirror that exact movement on the chart. Why not? Okay, so it's giving us a real insight into the market sentiment and where it lies, especially with the big guys out there that are trading. So you can quite clearly see here on the euro against US dollar on the weekly, we've had a major resistance level at 61.8. So notice in the setup, you'll notice straight away down the indicator box is primarily looking far more negative than positive. However, we know that the long-term sentiment is positive. Why is it positive? Because we've seen swing highs. You can quite clearly see prices moving higher. Bar this consolidation over here, prices has failed to break the prior swing. So this over here, this level here, 23.6, yet another monthly fib level, was a genuine support level in this case, and we saw price moving higher. So swing high, swing high. Notice now over the past couple of weeks, the euro has failed to really move any higher. Okay, it's above the institution, which is a very good sign of long-term positiveness, because it's trading above the institution moving average. Before, you can see that we did have a number of attempts of the institution moving average, but we failed to get above it. The candlesticks in this case are all blue, so it's telling us that the sentiment for the weekly, in fact, and the monthly is still very much upside favorite. Okay, however, we don't see price closing higher than the 61.8 anytime soon. There's more likely for the candlesticks to then start to plot negative. We do have our red arrow. The last week we gave a red arrow. It was a bearish engulfing candle, and you could see we had a shooting star with a bearish engulfing candle, and you could have actually shorted into the 50% retracement level as a valid target point. Okay, so now we're at the 50% retracement. One or two things are likely to occur. We could either see a consolidation because we're trading at that level, because anybody who actually knew this was a very, very strong resistance level would have shorted quite aggressively back towards the 50% fib level. We could see a consolidation here. The candlesticks are still very much positive, so we're still biased to the positive side. Remember, the candlesticks are very, very good in that sense, because even though we had pullbacks, and that's going to happen because that's what happens in a positive or negative trend, you're likely to see movement, then profit taking, movement, profit taking, movement, profit taking, and that's according to the fib levels in this case, or the support and resistance lines. Here, same difference. The candlesticks are still, even though we've had negativity over the past couple of weeks, in fact, the candlesticks are still plotting that there is still bias to the upside. So we're looking for positiveness. So if the fib level is here below us, that's likely to be a support level, and we like to see consolidation. The only thing that's going to really set this off for further lows is if the fundamentals don't stack up for euro against the US dollar, or the US dollar has a very weak session on their side, and that pushes the euro higher, or euro has some really, really negative or positive figures, and that pushes price higher and the US dollar lower, etc. Okay, so here quite clearly now, if we go down to our daily time frame, you'll notice that we have seen the negativity, and now you're following the rules of the template. Red arrow, red candles. Okay, the past 3 days, in fact, we've seen negativity now creeping into it. And if you look at what's happened over what you require in terms of the setup, you want to see the arrow first, then the candle has to confirm with the arrow. Then you're looking at your RMO to confirm with the actual negative sentiment or positive sentiment showing you on the candlesticks and the arrow. And then your RSMO is also going to be leading that. So the fourth criteria that you need straight away needs to be following suit. So I'll show you an example of that. Let's go to the arrow. Red. The candlesticks, red. RMO, below zero. So that's a negative. So I have 3 negatives already. RSMO, red. So I have 4 of my first initial indicators I'm looking for that are negative. However, the institutional moving average is still below price. That's a positive. The monthly fib level is still below price. So that is a positive. It's likely to happen. It's likely to be a support level. Okay, so on the daily here, you can quite clearly see a lot of negativity, and the R squared is complementing that negativity. So I know it's negative sentiment, and it's true negative sentiment, but my institutional moving average, which is the MA here, is still below price. So I can use that as a valid target area, a valid target level, but I've got my 50% fib retracement in between that. However, as price moves sideways and plots it, so is the institution moving average going to move higher, and those two might very well complement each other if we still see lower lows. Okay, you can see that on my daily we had a price swing low here, and you can see if I just plot a trend line, an intermediate trend line, you'll notice that price could in fact actually consolidate here and be pushed lower over the next couple of days, or heading into the new week next. So it gives me an insight. You can see how I'm building up a picture as such on the euro against US dollar. Okay, so I've got negativity, but these candlesticks are not really negative in the actual makeup, because if you look at them, they're all spinning top like, a lot more positive sentiment. Even though it's negative, it's still positive. We want to see bearish intent. If this is to be genuine bearish sentiment that's building up intraday, then we want to see that confirmed on the candlesticks. And the only way that's going to be a genuine signal would be, and if we see price closing below the 50 fib level to start with, but also below the institution moving average. Okay, you can hear below, but it's still blue. Here we have red, and if I just zoom out, and you can see the last time we actually had red, which was back in August of last year, we had a red arrow, red candles. Notice the RMO just dropped below there, just slightly. However, our red OSMO indicator here was dark red, telling us it was not genuine sentiment in this case. So we waited for the next candle to stay below the institution, and what did it do? It failed to do exactly that. It actually bounced. Let me see if I can try and find it for you. Sorry guys. Yeah, I think it's very, very important that you see this. There we go. Now I've found it. Zoom in, move it over. There you go. Okay, so we had a bearish candle. Yeah. So below the institution, below the monthly fib level. And if you look at the, if I just draw a vertical line, you'll notice the RMO dropped below the 0 level, and we had a bright red candle. So now, great. So now what you want to see now is you want to see a candle, especially on the 4-hour time frame, closing lower than the daily to tell you that the sentiment is then now moving in favor to the downside. And if you look at any other candlestick that preceded that, you'll see that there was a lot of pullbacks on that. So the 4-hour candle would not have closed lower on the movement lower, and subsequently you'll notice that we went straight into dark red, and the RMO was still below, but then you wouldn't have everything in your favor. You wouldn't have a physical close lower than the institution. You wouldn't have that physical close lower on the monthly fib, because it's now pulled back. It's now forming almost a tweezer bottom at a major support and resistance level on two fronts, and subsequently there was no trade lower. This candle over here had to be colored in and closed lower than these two levels to give us a genuine signal to trade lower, and subsequently we could then have targeted our 23.6 level at the bottom. That failed to materialize, and subsequently we've had a fake out, and subsequently that led to the next movement higher of the euro against US dollar. Okay, so I hope that helps in working out how to look for, or how to apply this particular template. Very mechanical in your approach, very little guesswork, and that's the beauty of it. Back it up with very, very strong sound money management rules, and you are on a winner. So sterling monthly, we're going to move on to this one. Here again, got a monthly chart. Take your all-time high to your current all-time low for the monthly, and you'll notice what's the first thing that sticks out. Let me get rid of this fib level to start with. What's the first thing you see here after that major fall from grace since the start of the downturn? You'll notice that price has been capped by the institution moving average on our monthly chart. Pull back through most of 29 into 2010, resistance. Fell, pull back yet again through 2010 into 2011, resistance at the institution. Movement higher, failed to get even back to that, so less sentiment. Move higher, back into that, less sentiment. Moved higher recently. Where are we trading right now? Okay, so you can see how the institution moving average has been a very, very, very strong prior resistance level. Back in 2009 after the pullback, back in 2011 on the pullback, and look where price is trading right now. So even though I know that my long-term sentiment still favors higher highs, you can see the negativity starting to form intraday as prices being consolidative intraday on the time frame. So I'm thinking, well, for the past 4 years we've had a major resistance level at this point. It has to be valid. Okay, we have to be well aware of that, because if we start to buy now, and we're seeing a lot of genuine sentiment from sterling against US dollar on our shorter term, i.e. our weekly, daily and 4 hours, and we're seeing a lot of growth in the fundamentals, etc. Everything looks fantastic. However, if you're still purchasing or buying, in this case against a very long-term major support and resistance level, or in this case a very strong resistance, you're likely to get beaten up. Okay, so here what we want to see, especially from the end of this month, January, is to see a bull close higher. Okay, we want to see the market closing higher over the next couple of months for this particular pair, and if it does do that, then it allows us then to tap into all of this, because she can go all the way back up to here from where she's come from, which would be the 2007 high. Now you could use your fib level, take the all-time high back in 2007 to the current low that we saw in 2008. Notice what the 38.2 level is also doing. It's telling us we also have a major support and resistance level in this area here. So now I know that there's likely to be a lot of consolidation in this area. So therefore I need to take that on board, because if I'm trading within this consolidative range on our shorter term time frames, i.e. my daily, 4 hour, hourly, there's more likely to be more risk. Okay, a lot more speculations, a lot more hesitation. Okay, and therefore a lot of wickiness, and I'll show you on the weekly what it's done. Okay, you can see here quite clearly over the past couple of weeks, price has been very, very hesitant because we are trading at the monthly fib. But they also know that above us there's a major long-term resistance level. This is the 4-year long-term support and resistance level. So ideally, for any further purchasing opportunities for sterling against US dollar, we would ideally like to see this month closing higher than 1664 and change, and to find support above that level. Because as it is now, if you were to trade this, you're trading with a lot more risk attached to your trade, because you're trading within a consolidation zone that's been effectively in play since the best part of 2009 onwards. Okay, so we are seeing a lot of growth for sterling, don't get me wrong. However, if you are to purchase now, you're purchasing into a potential major support and resistance level high, and you're likely to see more consolidation, which is clearly what's happening now on the weekly. You can quite clearly see we have a lot of consolidation over the past couple of months, in fact, and you don't want to be trading that, because all you're doing is literally wasting time, because time will carry on, a lot of consolidation will continue to happen, and eventually what could happen is you could be triggered out of your trade, your stops could be triggered, and therefore you're incurring a loss. Okay, so daily, you can see a lot of consolidation, and that yellow line represents my monthly major resistance institution moving average. So ideally for me, I've now put in a trigger alert for a physical close higher than that, ideally on the weekly or monthly, in fact, and then I will then reassess the chart to see if it's genuine, and then I'll start looking to the upside. US dollar Swiss franc, here again you can see a major fall from grace for this particular pair, going all the way back to 2000. Okay, you can see that price, the candlesticks in fact have been negative and have not changed color since the best part of 2000. Okay, we've had we've had a number of blue arrows, but you'll notice that we've never got any blue candles to confirm that was genuine sentiment. Look at the RMO, guys, from when she actually dipped below the zero level, which was here back in 2002, in fact, to currently where she is now. The RMO has clearly been below the zero level and confirming a very, very strong downtrend. The institution is way above price on the monthly, and price has bounced significantly recently, but you'll notice that she has failed to make new highs as well. She made an all-time, she actually pulled back to a price support and resistance level. There we go, price support, support yet again, then the breakout, the pullback, and then the continuation lower. However, once she's actually found support here, a nice hammer with a bullish engulfing candle confirmed that. So we saw a lot of buying sentiment coming through for the US dollar against the Swiss franc. She has failed to break above that major support and resistance level, which was so paramount to see if this was genuinely a change in the setup from one of negativity long term to one of positiveness for the US dollar against the Swiss franc. She's failed at that hurdle, guys, and if she continues to fail at that hurdle, she's more likely then to start moving lower again and conforming to the overall trend, which in this case is one of negativity. Okay, so the candlesticks are telling us that. Okay, so we have a red arrow, red candle. Notice the long-term sentiment over here for the US dollar against the Swiss franc is very much negative. However, our intraday sentiment is one of positiveness. Okay, so going back to drawing support and resistance levels, very, very important. There's one or two things you could ideally take the shorter term move lower. You can quite clearly see over here, for example, we've had a nice bearish trend lower recently. Well, I say recently, since 2010, in fact, to the current lows we saw in 2011, and subsequently we've had a bounce higher. So I could take my monthly fib from that level to the current low on the chart, and you'll notice how price has actually been moving between these fib levels quite scarily, predominantly to those points. And you'll notice what price is doing right now on the hard right edge. We've had a lot of negativity over the past 4 months, selling with a bearish intent, and prices moved sideways, however moved back down towards our 38.2 monthly fib level. And now you can see when we got there, we've seen a lot of consolidation now, and that's all that buying sentiment that we're seeing now coming through from our 5, 15, 30 minute, hourly, 4 hour, and heading into the daily. The R-squared is not really complementing that daily yet in terms of the buying sentiment, because overall the sentiment still favors the negativity, because we are very much in a negative trend. Weekly chart, you can quite clearly see we had a lot of negativity through here. You could have actually seen there were other price support and resistance levels within the monthly fib levels, so valid target areas, breakouts, pullbacks, and continuation levels. But you can quite clearly see as we headed into the monthly fib here at 38.2, you'll notice a lot of hammer formations, and subsequently the longest you found support here, the more likely buying sentiment was going to come into play, and then see a knee-jerk reaction, or consolidation, or move higher in this case. And that's subsequently what's happened over the past month or so. We've seen price moving higher again, and reattempting, more likely to see a reattempt of the swings that we've seen lower. You'll notice recently swing low, and you'll notice that we've had a breach. We had a shooting star formation. However, last week's candle, in fact, bearish, bullish engulfing the prior week negativity, and you can see prices now testing the price support and resistance level here at 91.15. So looking for any opportunities here, you would, if you are to see any further opportunities higher on the daily, in fact, it would be, you'll notice that we had an opportunity back here in November of last year. We had blue arrow, blue candles, RMO was above, the OSMO was above, which is fantastic. However, we're still below the institution, and it's very, very important. The institution moving average ideally has to be below price if you are getting a genuine buying opportunity. So here we have a blue arrow, blue candles, the RMO is above, the OSMO is above, fantastic. All four are looking fantastic. However, the thing that worries me the most is the candlesticks recently all being indecisive, spinning tops, dojis, which are not clear decisive candles. We are trading at a price support and resistance level, i.e. a 2-week high level here at 91.15, and most importantly, the institution moving average is still above price, which is not a good sign, because that's negativity. So ideally here, what I want to see from the US dollar Swiss franc going forward is I want to see a bull candle, which is an intent candle, a sentiment candle, and it has to close above the institution moving average. End of story. Okay. Last bit of the day, the US dollar Japanese yen on the monthly. You'll notice we saw a major fall from grace for the US dollar against the yen, starting back in 2007, 2006, and then finding support through 2012. Well, the building process started in 2011. 2012, we saw a lot of fantastic non-farm payroll figures for that, and that really started the catalyst for the US dollar to gain strength against a very weak yen. Fib level high would be the one we saw in 2011 to the current low that we saw through 2011, 2012. Notice how uncanny prices move between these fib levels. Okay, clearly, recently we had a major wedge formation which took up most of 2013, but when we had the breakout and above, especially the breakout above the 50% fib retracement, there was a valid trade towards 61.8. And notice where on our monthly now, where the institution moving average is moving towards, and where our price is trading in terms of the monthly fib level, 61.8. So we have a confluence of both our institution moving average above price, which is resisting, and we have a 61.8 monthly fib level, which is also acting as resistance, and hence the reason why we've seen a pullback recently. Drop down to the weekly chart. Straight away I get a buy signal on the weekly, and if you look at the weekly indicator, everything's looking fantastic, including the R squared. RMO is above, OSMO is above. The only thing that's not in our favor is the fact that we are seeing the OSMO turning bright green, which is telling us it's not genuine buying sentiment, but that's primarily because we are trading into a resistance level. That's a 61.8. So here, guys, all I'm looking for is for the US dollar to close higher than the 61.8. The candlesticks are still blue, so I know that I'm still looking for positive sentiment. Wait for the candlestick to close on the weekly higher than 61.8. This will all go blue and correlate with our long-term sentiment, because by price moving higher, we're getting the buying sentiment starting on our 5, 15, 30 minute, etc., leading into our weekly. That would confirm. Then I know exactly, if I get a close above 61.8, I know where my next potential target is. It's 78.6, and that's a healthy, what are we here, 842 pips away, guys. So I know my target. Okay, even if I went for a stop under the price swing over here, that still outweighs more. It's not going to be more than 100 pips, and that's more than enough. In terms of money management, that's perfectly well. However, the longer price fails to get above the 61.8, the more likely prices tend to stall, and the sentiment starts to favor the downside. And if she does do that, then she would likely favor back towards the 50% monthly February retracement level we've just come from. Okay, which was the wedge breakout, which was that pattern there that we saw, the wedge. Okay, so that's it, guys. Very mechanical. I hope it's made sense. I hope it's helped you guys really understand how it is that I go about plotting what I'm looking for the following week, and it'll give you an insight on how exactly I treat my trading. Very, very mechanical, my approach, and then I apply all my trigger alerts, etc., and wait for price to show us her hand. Once she's shown us her hand and I know exactly where the big boys are trading, then I can move with the big boys quite comfortably, because they're the ones that are pumping large amounts of capital into the market, and that is something where we're going to start seeing our movement. Okay, so have a fantastic trading day today. There's a lot of news out for sterling this morning. In fact, if you are trading GDP crosses, just be aware that there's a lot of news out for the UK market this morning, and then we have a lot for Canadian dollar this afternoon. In terms of the, we have the Bank of Canada rate statement. Okay, we have the interest rates, overnight interest rates announcement, which is at 1 at the moment. They don't see a change in that interest rate announcement, but be well aware of it. Okay, guys. We have public sector net borrowing figures for sterling for the UK market, unemployment figures for the UK market, the official bank rates vote statements. They don't see a change. The MPC doesn't seem want to change the actual interest rate. Claremont count change. There's a lot of data for the UK market to be well aware of. Okay, so that's the big one today, and then followed by CAD, and then just if you are looking to trade those particular pairs, be well aware of them. Okay, have a fantastic trade day, and I'll catch you guys first thing tomorrow morning. Until then, you guys trade serenely.